I talk with a lot of people on a daily basis that want to be able to trade the news in the market. News are appealing, action takes place fast, you get some results quickly, and you can make pretty big gains with those news, if you trade them the right way, of course. Now the thing is, if you just jump into trading news and high volatility markets, that's not going to work that well. And you need to be prepared, you need to have a plan first in order to dive into those news releases or those high volatility times of the market. And that's exactly what we'll cover in this video. What's up, traders? Welcome back to Chiang Mai in Thailand. I'm sitting here in the hotel. It's like really chill, really nice. I love it. And I'll be talking about basically this topic of news trading. This is a video that's sponsored by Pepperstone because they're awesome people and they're able to answer topics that I don't know much about, which is awesome. I've never really traded news well. I've never really wanted to trade news that much. But if you want, and I would suggest if you like that topic, that you want to trade news, well, it's possible to do it as long as you have the right framework around it and the right tools and the right knowledge within that topic of news trading. So I had a chat with Chris Weston, who's working at Pepperstone. And the first thing I want to know from him is what are the news releases or the events that he's looking at on a weekly basis? Well,
I've been trading for close to 20 years now, both from an institutional perspective and also from my own account. And I know that the markets work in a cycle. We become fixated on a macroeconomic topic, a political topic, and we wait for the circuit breaker to evolve. What is going to give us the clarity to answer the questions that the market's asking for? And that's something we should get fixated on a specific date. So I'm a big believer that markets tend to work in cycles, where there's an element of how we trade into a specific date, which is the news. And the little parts of breaking news that go in those cycles. Then we actually get the event itself, be it an economic release like a non-farm payrolls number, a Fed meeting, or even an election if you want to go really high up political. How we trade around that announcement is something that we can discuss, but certainly that's where you get the high volatility, the liquidity issues that come through. And then of course we've got the stage 3, if you want to call it that, which is the fact, where the market understands exactly what's happening, and then we form a consensus view about what that actually means. And so that's the way that I think about the world, is really is the lead up to an event, what happens around the event, and of course the aftermath. And around that situation, you're going to see different psychologies, assets working in different situations, and then volatility kicking up higher or lower depending on how close we are to the event. And that has big dynamics on things like how much risk you're taking on, your position sizing, and those factors as well. So look, I think the way I think about the world is from a sort of more of a macro discretionary view, and I'm taking a view about what is the key thematic that the markets are fixated on, whether it's Brexit, whether it's trade disputes, slower economics, and then trying to find out what is the circuit breaker that gives us the clarity of thought there. Well, I look at what is the big talking point in the market. What is the overriding thematic that markets are moving to? When you see everyone looking at a situation, it could be like the US-China trade relations, and are we going to see a breakdown? Are we going to see a convergence? And what does that mean for the global economy? You tend to see China assets working very closely, the proxies of China, such as the Australian dollar, working pretty closely, dollar CNH in play, copper moving around. And I think when you can identify the key theme, you can then identify what is the news that you're looking out for, that the market's trying to understand. What does the outcome of that piece of news mean for that bigger picture situation? If we're talking about a global economic slowdown, we're really interested in things like US manufacturing, the ISM manufacturing, and we're probably less infused about what's happening in the labour market. If we're looking at what's happening in the Brexit scenario, we're waiting for that key date that gives us clarity there. And again, we're looking for that date, and markets trading into a specific date, a specific timeline as well. So I think for me, it's understanding what is the big picture situation, whether it's a global slowdown, a specific slowdown in a certain country, weakening labour markets, because the central bank has said, the key issue for us is what's happening in the labour market. And therefore the market needs to be interested, because if the central bank are interested, the market needs to be interested as well. When we can understand what is it that the market's really looking for to give us that clarity, then we can identify the news and the economic release, or the key data point that we really need to be interested in, and trade around there.
And here, of course, I can only speak for myself, but in the past, I used to put a lot of emphasis on actually not trading during the news. I would kind of swing trade on higher time frame. And I also checked the fact that it would be better for me to exit trades before news or to not place trades near a news event. Now, over time, I went to figure out that this was only partly true and that I would still make a lot of profit sometimes in news. And so I kind of put this rule aside, but I kept for a rule for myself that I would not place a trade before a speech, or if I had a trade open, I would at least move my stop loss before a speech. And Chris had a pretty similar opinion on that topic.
Well, I think they've all got their place. As I'm talking about here, it's what is the key driver, and what is the market really looking for? And if it's the idea, for example, if we take one situation, which is, if you're trading dollar yen, for example, which is very sensitive to what's happening in the bond market and where yields are going, both nominal and real yields. You're looking for not just whether we're going to get a rate cut at the next meeting, but the extent of rate cuts going out further across the swaps curve or the rates curve going forward. And therefore, what is firstly, if we're looking at the data points, what is the market really looking for? Is it going to be a continued slowdown in the manufacturing space, or are we looking at more things that are going to give us a really clear that the Fed are more sensitive to, such as consumer confidence or a weakening labour market? If we could understand that, then we know that the market's really quite interested in that. The second thing is then when that data point comes through, we then need to regress that against what central banks are saying. So central banks give us an opportunity to mark to market where the rates market is, where the currency market is relative to where they see things. And it gives us a chance to say, well, we've had this data coming out, it's better or worse. Now, how do the central banks see it? And of course, in this situation, I will look at very closely at rates pricing. We can look at Fed funds futures, euro dollar futures, or whatever the currency is. It could be Euribor or ONIA rates. And it gives us this understanding of what's actually priced in. And when a central banker speaks, then we get a chance to understand what their outlook is relative to what market pricing is. And of course, that's where currency trading is really all about. It's looking at misalignments in this pricing. So that gives us a good chance. The data gives us an idea about what we think should be happening. And when the central banks get to speak through these speeches, it gives us a chance to really rationalise and aggregate market pricing relative to these various speakers. Now, of course, what you're looking for when you're seeing these various speakers, let's take the Fed for example, is you have what we call a dove to hawk scale. Some speakers will be much more hawkish, i.e. they're looking for a normalisation on a positive side. They want to raise rates or keep rates as they are. And then you might have the more dovish members, the people who are looking for more accommodative stance, your James Bullard of this world, the Kashgaris of this world on the Federal Reserve Board, and they're looking to ease policy. So what you want to do is these people are more dovish. You want to see a situation where they perhaps come more hawkish, and then that's a bit of a surprise, and the market's going to be saying that. Or you might get someone who's such as Esther George on the Federal Reserve, who's been calling for rates to be kept on hold for some time, whereas the market's been looking for rate cuts. And when she changes her tune and becomes someone more dovish at the margin, then that's a big surprise for the market. What we also want to see then is the idea of what they portray. They could come out with narrative about more aggressive easing, and what we're trying to do as traders is understand what they're saying relative to market pricing. If there's a difference between the two, that's when you see reactions around the news.
Now, when it comes to your trading plan around these news releases, a lot of people will tell you, well, don't trade the news, but trade the reaction to the news after the news is over. Some people will say, well, you got to be in the news, trade it fast, and get out quickly. So what's the best?
Well, the easiest thing for me, the best way to think about this for myself is whether or not I want to be exposed around something that is almost a binary event. When there's something that is the market is very sensitive to, and they're saying that this economic data release or this speech could really change the dynamic, and the best way to do that is for me is to have a look at implied volatility in the market. If we have a look at overnight implied volatility or 1 week implied volatility, and you see it is high, the market's expecting a big move, and we can actually rationalise that. I put out a daily report called the Daily Fix, which we send out to clients and subscribers. And we talk about implied volatility in the market. And for me, when you see that very high, the market's expecting a big move in the options pricing. And we can extrapolate to mean what that could mean for spot prices as well. And when I see a situation where implied volatility is high, and we also see that it could go either way, the risks are fairly symmetrical. To me, I don't want to be involved in that situation. I could get lucky, and I could be, and the trade could work out quite well, and I could get a nice move. But at the same time, I could see my account in duress because the trade's gone against me. When there's something which has high volatility, the market's expecting a big move and it can go either way. To me, honestly, that's a low probability trade, and I don't want to be involved in that situation. So I can actually quantify what's expected from a certain data release by the implied volatility in the market, and we can actually extrapolate that through straddle pricing or strangle pricing in the options market as to the extent of the move. We can buy and sell volatility around that. So we can actually quantify that for the spot market. So that's the best thing for me. When you actually see a situation where high volatility, I don't want to be involved in that, to be honest. It's a flip of a coin. And that can cause big and erratic moves. When we see low volatility, low implied volatility around a certain economic release, that's kind of a bit better situation. It's probably a situation where the market's saying this release doesn't really change too much. It doesn't change the dynamic that fits into this bigger picture situation. That to me is kind of no issue at all. Whether you're a technical trader, whether you're a discretionary trader like myself, I think having an understanding about the event risks that are coming out throughout the week is absolutely key. We are managers of risk. That's one of our primary jobs as being a trader. Understanding, therefore, what the event risk is coming through and where the market is sensitive to is just so important for me. Do I want to be exposed to that meeting or not? And I think that's where the options market can come in really well, and that's why I look at implied volatility, very, very keenly to understand not just what I think, but what the market's expecting around certain events. And for me, if it's too high, then I don't want to be exposed to that. If it's low, then that's fine, and that continues with the journey that I'm on already, and the reason why I was in a trade originally.
And of course, the other thing that goes along with that is what strategy do you have to use in the market to trade news? Can you use anything, or are there things that are better than others? What would Chris suggest for trading these news releases?
Well, trading news is very difficult. I mean, we see people looking to say, I'm going to buy the Aussie dollar because I think the RBA are going to keep rates on hold. And, you've seen a situation where, the market's discounted, say, 70% chance of a rate cut. So, people buy the Aussie dollar on the idea that they're going to leave rates unchanged. Now, it's never that simple, in my opinion, because what you could see, if we use that as an example, is the RBA, the Reserve Bank of Australia, actually leaving rates on hold, which would cause a momentary spike in the Australian dollar. But then if you actually read the statement, it gives the impression that they're probably going to go and cut at the next meeting. So therefore, then you get this spike up and then you get this immediate move back down. So people who have been buying, be it systematic or actually just using a buy stop order, for example, that market comes up and comes down very quickly unless it's hit their limit. So I think trading news and trading the exact has become very, very difficult in that situation. So I think there's certainly an art form to trading news. I think most educators would say to clients, don't actually trade the news per se. The easiest money for me is actually in the lead up to a marquee event, and then also in that stage 3 that I talked about, which is when we actually find a fair value, when the market has a fact, it has the clarity to understand what does this actually mean. What does it mean for economics? What does it mean for potential changes in Fed policy or central bank policy? What does this mean for government initiatives? Could we see more fiscal action coming through? And when we actually form a consensus view, that's when we tend to see trends develop. So I actually look at, if we're talking about a stage situation where we see markets trading into an event, stage 2, which is the event itself, and then stage 3, which is the aftermath, the fact, and we know the facts and the market's trying to actually form a fair value as to what this actually could mean. The event itself, especially marquee events, are very difficult because you can see erratic behaviour. Liquidity becomes an issue. Brokers, liquidity providers pull bids from the markets, and you get these kind of erratic moves. That's when you get this talk that people are stop hunting and various factors. But ultimately, if you aggregate that, you get liquidity issues and markets becoming very erratic. That to me is a very hard situation to trade. I think about the psychology when we're all acting as one body. You get one person coming out and saying that this is going to happen. The market all acts as a collective group, and you tend to see trends going into these marquee events. That to me is an easier hunting ground for profitability in FX trading, as we all come together to say what if. And then of course stage 3, which is the aftermath, when you've got that fact. They're the two easier places to go hunting for FX profits, to be honest, is when you're speculating on an outcome, and actually the aftermath when we get the fact. The actual event itself, you could get lucky, you could lose, you obviously could get unlucky as well, or you could see a situation where you see a sudden move up and a very, very quick down, in which case you've lost either way. So I think that stage 2 around the event, there's an art form to doing so, but I think when you've got to be in and out so quickly, it makes life very, very difficult. So I think about the when we identify a thematic and a circuit breaker and a date for that circuit breaker. You think about the idea that you are seeing this psychologically, how markets trade into the event, the actual event itself, where liquidity and bids and offers and everything are moving around, and then the aftermath when we get the fact. Think about how markets work in that cycle.
Now, recently, on a slightly different topic, we've seen a bunch of different volatility in the markets. Sometimes the markets are like really low volatile, sometimes they're more volatile. It really depends. And so you need, I think, to know how to adapt to these things. That's something I learned a lot the past year, is how to adapt to different volatilities in the market, to different like tight ranges or big swings. How do you change your style? What do you do to be better and to kind of still have gains in these market conditions?
Well, I think you need to think about this in the sense of what is volatility. Well, most people who are watching this video would already be using realised volatility or historic volatility. This is statistical fact. It's happened, and we can regress that. And most people would use a Bollinger Band, for example, or an average true range. The Bollinger Band is statistical fact, and effectively most people use a 20-day moving average, and it's the dispersion of prices from that mean. The wider those dispersions of prices, and most people use a two standard deviation, which calculates 95-96% of those distributions. You will see a situation where people will use that very nicely as a mean reverting tool. And that works quite well for people. You know that two standard deviation Bollinger Band is something that is used very widely, especially in a sideways trading market. When you see the RSI around 50, people will use that Bollinger Band quite effectively with an RSI as a mean reverting tool, but also in a trending capacity as well. But you can tense when higher volatility has happened, because those Bollinger Bands will widen. That's showing you that prices are moving further away from the mean, but being captured with that two standard deviation. The average true range is something that a lot of people will use effectively for money management and position sizing. When the average true range, I tend to, if I was going to use one, I'd use the 5-day. Is you tend to look at that and work out how far away I need to put my stop loss based on the average true range. Some people will use 1.5 times, and the further that is away, obviously the smaller position size you need. So that's something that people use all the time. I tend to look at implied volatility in the options market, and as I say, I put out a weekly report which talks about how this all works. Now, this is not me thinking about it. This is what the market is implying about volatility going forward. And that volatility effector is traders anticipating moves up or down. Volatility is directionally agnostic. And from the current price. So it sort of talks about where this is going to go in standard deviation terms from the price. So I think when we see higher volatility, and what we tend to do is try and put context on that higher volatility. The higher the volatility within that 12-month range, we use percentile ranking, will give us an understanding about what the market's expecting. Are we expecting a big move up or down? Now, that works really well for certain strategies. But if your strategy, whether you're using an expert advisor or whether you're using a discretionary or just a pure technical strategy, if it doesn't work well in a higher volatility regime where you can get those big price moves, markets are probably driven by headlines, liquidity becomes a factor. That to me is a massive consideration, not just for your strategy itself, but actually your position sizing. Your position sizing is one of the most important parts in assessing position sizing of your trading process. Volatility is an absolute core measure of that situation. So if the market is either seeing high realized volatility or high implied volatility, in that situation, I'm going to use a wider stop loss, because obviously the market's implying there's a higher degree of risk that's coming through and a bigger price move, and therefore, if you've got a very tight stop, your chances of getting stopped out are very high because you're taking on risk. Of course, you're going to have to take a smaller position size. So in terms of actually risk and in terms of position management, higher volatility is absolutely essential. But if your EA and your strategy doesn't like to work in a high volatility environment, that may be a time when you want to stay out of the market. I look in FX markets, for example, and a strategy that works really well in a times of sideways trending markets or positive equity markets, lower tighter credit spreads, is a situation where people tend to go into carry trades. They like to go into the high yielding currencies, the Turkish lira, for example, if you really want your poster child of carry and that high yield, and also the US dollar to an extent. But certainly the carry trader work really well for a fundamental perspective, but you need those market conditions to be there, that being low volatility and positive risk environment. On the other side, if you see higher volatility, that trade will unwind very quickly. But there's obviously a number of other strategies, mean reversion, trend, all those other factors that coming through, and that is really a function of volatility. So whether you're looking at realised or what I like to look at more closely, which is implied volatility, forward looking, I really like to get a sense that volatility defines not just your strategy, but your risk management and your position size as well. So for me, volatility is the absolute core of my trading process. Well, I think it really depends on how low it is, to be honest. And also, it's not just a function of how low it is, it's what's causing that low volatility. As it stands at the moment, we've seen fairly low volatility in FX markets, and all the volatility has been taking place in things like oil, gold, and also equity indices. So why has there been low volatility in FX markets outside of the pound? You've got to understand why. Certain currencies have higher volatility, and of course that's when we've got an event around that, which is a political event. As it stands at this precise moment, the market is very on edge, and therefore volatility is very high. When you have uncertainty, you're going to see higher volatility because people are trying to ask questions, they're not getting a lot of answers, and therefore you can see big moves. But the rest of G10 FX is seeing fairly low volatility. You're certainly seeing that in euro dollar, and the reason being is if you look across G10 outside of the political currencies, all central banks are moving in alignment. They're all looking to cut rates. They're all becoming accommodative, and that's suppressing volatility. So why we ask the question, what's causing that volatility or the low volatility? And it's the fact that all central banks are becoming accommodative. They're all moving in alignment. You're not getting that central bank divergence, which creates volatility. And so in that situation, I've understood that there is low volatility, but I've understood what's caused that, and then I can work within that regime. So if we take euro dollar, obviously one of the most, if not the most traded currency pairs that you've got amongst sort of retail, you've got a low volatility environment. So, how does the technicals look? But for me, in that situation, my number one consideration is what happens with my stops, what happens with my risk, and ultimately my position size. And I know that I can have a tighter stop loss than I would do in sterling, for example. I might take a bigger position size, but then I might actually, look at my risk reward. And if I'm looking at a sort of 3R, I'll be looking at, is that too aggressive? So effectively, the whole concept of low volatility, how low, how can I quantify that using implied volatility and straddle pricing, for example? And therefore, if I can understand that, I can understand how much risk I'm taking on, how much reward do I want to get back in that environment there as well. Well, I think news is inevitable. I mean, look, I think first of all, if we can measure or quantify the expectance in the market, and that's why I keep looking at this implied volatility structure. With implied volatility, you can actually understand the expected move in the spot market that we all trade as FX traders. I think that's absolutely key. If the market's expecting a big move, my advice, and you can see if you look at the playbook, and what I do as a trader is and I think when you're looking at being a strategist and a trader, they're two very different things. But as a strategist, what I'm trying to do is I'm trying to break down the event, and I'm trying to say to myself, if I can look at the consensus, let's say we've got a non-farm payrolls number where the market's looking for 200,000 jobs. I mean, there's more to it than that, things like wages and the unemployment rate and the participation rate and the U6 rate as well. But if I know that the market's most sensitive just to the headline number, I'd say to myself, well, let's have a look at the playbook. What happens where does the market see this as a good result? And what will this mean to Fed policy? And then I'll look at the currency which is the most at risk of this. So I'll look at dollar yen perhaps more than any of the other currencies because I think it's most sensitive to the bond market, which is most sensitive to the non-farm payrolls number. So I would say to myself, well, what's the number there which the Federal Reserve, I try and get into the mind of the Federal Reserve who are looking at this very closely. And I'd say, what does a good number look to these guys? And I'd say probably, let's say 230 to 250. Anything above that number would be obviously a US dollar positive because we're going to see rate cuts being priced out of the market. Then I'd ask myself, what is the extent of the reaction? Again, I go back to the options market for that. I also then ask, what happens if we get an inline number, and what happens if we get a poor number, and what does a poor number look like? So I've devised a playbook around that, and I think everyone should be doing that in that situation. Is try and understand, what is a marquee event, and devise a playbook around that, and then ask yourself, do you want to be involved in that market, and what are the inputs suggesting that that give you the risk that we're going to see an upside number. You might look at things like ADP payrolls, the employment numbers of the manufacturing, and also the services number, and I can therefore devise a probability matrix based on this playbook as well. And that's how I'll break down. And then I can use that in my trading because I've got a really good understanding of the news and event risk itself. And when I'm running a dollar yen position, I can ask myself, well, actually, I've got confidence that it's going to be a fairly low impactful number, and I'm happy to hold that position over the news. If I'm worried about that, if I think it could cause a big move either way, and I'm not buying dollar yen for that event, I'm going to close out the trade. It's a risk to me, and as a risk manager, I don't want to be exposed to that. So that's kind of how we can think about being a strategist and being a trader at the same time. As a strategist, I'm looking at the event risk, I'm devising playbooks, and I'm using that therefore to assess my risk, which I've got my position on.
Now, my last point for this video is, if you've been trying to trade news in the past, you've tried, you've maybe failed, you felt discouraged. Well, it's not easy for sure. It's something that takes patience and practice, and sometimes people that trade news are not too patient. They want to get the result fast, and I think that's how people fail sometimes. So if you've not gotten a result with news trading so far, don't discard it as like, oh, it's bad, it doesn't work, it's never going to work for me, I'm a loser and everything around. Don't do that. There's always a way to go and move forward and still get back to it and try new things and improve. So guys, in conclusion, I appreciate you once again for watching this video here. I hope you liked it. I hope these tips were useful, of course. Comment below with your thoughts, and here are a few comments as always in the past video. You guys, if you want to be featured in the next video, comment below this one. I'll leave a link below if you want to sign up with Pepperstone. They are a good broker, and I'm often asked why I don't use them. Well, they're not available in Canada and in the US, and that's pretty much the reason. But they are really good people, so if you want to sign up with them, you should go if you are able to. They are like really cool people. They'll prepare for you a special package, so check out the link below for that. If you want to have a good kind of partner for your trading and stuff that can help you out move forward, Pepperstone is a really good deal for that. Yeah, they're just awesome. So check out the link below for that, and I'll catch you back here for the next video pretty soon. Ciao.